So, as you look back, not just at the last 14 months or so, but even beyond that or before that, what do you see, and what do the numbers? And when I say numbers, I mean the benchmark indices tell us, and what do they not tell us?
One thing which they will not tell you is that I think for most of your viewers or listeners, their portfolio would not be touching all-time highs.
Correct.
Not just the retail investors, I'm talking ultra HNIs, family offices coming to me and saying, I don't have unrealistic expectations. I'll be happy with 30% compounding. I said, that is an unrealistic expectation. Other thing is which you're not talking about is the currency. Because now the interest rate differential between India and US and other Western countries is the lowest. It is in the 2% range.
I mean, there are some who are arguing for gradual depreciation or letting it go where it is or where it will go, and others maybe.
And in fact, that is the reason, one of the reasons why Indians should invest globally.
Tell me about an instance where, let's say, your emotion was superseded by your machine.
Maybe you would not have looked at industrial machinery, capital
Okay.
goods, because it had been such a dog sector. But in systems, there is something called a broken leg analogy, that the system will be better at predicting whether someone will go for a concert. So you should overrule only if you know for certain that person has broken their leg and won't go. Get your broad asset allocation right, put the risk management parameters, especially stop loss, in place, do proper global diversification. That's all you need to do.
Devina, thank you so much for joining me today on the Core Report. So it's an auspicious day of sorts because we've seen the markets hit fresh peaks and having recovered from the last peak seen in September 2024.
Right.
So September 2024 to November 2025, it's been a bit of a journey. So as you look back, not just at the last 14 months or so, but even beyond that or before that, what do you see, and what do the numbers? And when I say numbers, I mean the benchmark indices tell us, and what do they not tell us?
One thing which they will not tell you is that I think for most of your viewers or listeners, their portfolio would not be touching all-time highs.
Correct. Yes.
Because this has been an extremely narrow market. Especially up to August, it was very, very narrow. At that time, only about 10-12% of the stocks were outperforming the index. And I think something like 35% were down more than 50%. So, I mean, in a normal market, you would expect about 40% plus of the stocks to outperform. When it becomes 20-25%, we say it's a narrow market. So to have it as narrow as 10% is extremely narrow. It's broadened a bit from there, but I think still only about half the stocks are down more than 20-25% from their all-time highs. So I'm sure, the euphoria may not be as widespread as the indices show. The other thing to remember is that sentiment is a contraindicator, and this is not something I'm saying. This has come out of research studies in whichever country the research study has been done, whether India, US, Portugal, Brazil, that when there is excess buoyancy in the markets, the euphoria, I mean, like if I go back, let's say 15-17 months, not just the retail investors, I'm talking ultra HNIs, family offices coming to me and saying, I don't have unrealistic expectations. I'll be happy with 30% compounding. I said, that is an unrealistic expectation. But I mean, last year it appeared the money was there for the taking. I mean, people told me that, why do you say risk management first? Why do you say conservative management? We want to take high risk and get high returns. The only thing certain with high risk is high risk of losses. Nobody is guaranteeing high return. But the flip side to that is that when you are asking yourself, should I get out of the market? Should I stop my SIP? Is exactly when you should be invested, because the next period returns are above normal. I mean, that's the other side of the equation. And right now, if you look at the indices, there's no point looking at, even at a crude PE level, looking at the index PE, because the composition of PE has of the index has changed so much. I mean, you and I have been around long enough to remember a time when there were no banks in the Sensex and Nifty, and now that's the highest weight. At one point, these indices were full of PSUs, and then there came a time people forgot that PSUs were listed. So these are all cycles. But if you look at the sectoral PEs, these are not at extremes. In many sectors, they are actually below even the last decade's average. And these are not on particularly great earnings. I see an uptick in earnings coming. So So between that and the fact that PEs are anyway not so stretched, I don't see grave danger in the market. So everybody understands the danger of being invested in the market, the risk of being rather invested in the market, but there's also a risk to not being invested. And we had done this data, so like from the time Sensex started, which is 40 odd years, said what if you missed out on the 10 best days? Now it seems like in 40 years, 10 days shouldn't matter. But actually 2/3 of your returns go. So instead of that 100 rupee becoming, let us say 85,000, you're now at 27, 28,000. If you miss out on the 30 best days, which is not even an average of 1 day a year, you miss out on 90% of the returns. So most of the time, unless you can foresee a really big crash, it pays to remain invested. But the other side of that is that you cannot, buy and forget. So don't think that I bought this stock last year at 100, now it is 65. I will wait till it is 100. It will never come back to 100. It may not come back to 100. The market has absolutely zero interest at the price at which you bought. So you have to look at what is a good place to be invested today. Don't have loyalty and love towards your stocks.
Right. So when you talked about narrow markets, which means there are a lot of stocks that have now fallen by the wayside or fallen back.
Right.
Why has that happened? And if you were to illustrate now with some examples maybe that are sort of you've been following.
So, I mean, if you look at last year, a lot of that euphoria was in small caps and micro caps. And even now the PEs are quite high for that cohort. And I was not in hindsight, but at that time I had said, look at the history of small caps. The small cap index fell nearly 80% in 2008, 78% to be exact. It took 8 years before it came to that level, but that's also theoretical because the index churns more than 20% every year. So 8 years later, it is a completely different index, and that's a characteristic of the euphoria in small caps in any cycle, that the stocks that do well in one cycle are not the same ones that come back. It's a whole different list. In fact, even now I was looking at I haven't quite collated the numbers, but I looked at it, that all the stocks that have gone from mid cap to large cap, small cap to mid cap, and the other way around. And always the number of stocks falling down from large cap to mid cap and mid cap to small cap is more than the number of stocks that go up the list.
That's something which I'm sure most people don't look at or
notice.
And
after I was at 2016, so 17, 18, again there was this mad bull market in small caps, and again there was a 2/3 fall. So last year, many of these small cap managers who were saying we've given 50% compounding for 3 years, I said, don't forget your school maths. When you come down 80% and then you compound 50% for 3 years, you're still down more than 30%. So that's the nature of the beast. I mean, always remember, I mean, again, you will remember this, that how many IPOs came in the 90s? There were 2 years when there were more than 1,000 IPOs each. And today only about 4,500 stocks trade actively. And the number of listings on the Indian markets is, I think, more than 3 times that, if not even higher. So that means, more than 2/3 of the stocks ever listed are not even trading. They have essentially gone to zero. So that is the flip side of all those who tell you buy and forget or long-term investing. That's, you remember the successes, you forget about the failures. It's like...
Right. And if I were to go deeper into that, the small cap phenomenon that you talked about, so would that be sector driven as well? I mean, were there some categories or types of companies or sectors which suffered or saw more damage than others?
Yeah, there would be. And there are always these themes that sort of catch the fancy, and then need not even be only small cap. So I always say that...
it could be across the board.
Yeah, I say the easiest rule of thumb to see where there is excessive froth in the market is to see where the NFOs are coming. Whenever there is a cluster of NFOs on a particular theme, and this I'm not talking just 2 years, we've collated the data for 25, 30 years. That it is a pattern that when there is a cluster of IPO of thematic funds being launched, it is almost always close to the peak of that thing.
Yeah.
I mean, whether you go back to the early 2000s, the pharma fund, the IT funds, and whether it was, defense, PSU, small caps more recently, it always comes at the peak of the cycle because it's easy to raise money then. By that time, every person on the street knows about it. There's this FOMO feeling, my friends made this money in this theme and I didn't, so let me get in. So that always happens.
And what would have sustained? I mean, I'm trying to single out sectors again. So you mentioned defense, maybe flavor of the month season, and it's maybe gone now. Maybe consumer tech is a flavor currently. We don't know right now. IPOs are mixed. So what are the sectors or themes that have sustained through this period?
So, I mean, I can tell you how we were positioned in our PMS. So, since last year, we have been overweight pharma, healthcare and auto components. We've added a little bit of autos. This year, through 2025, slowly, I mean, our systems have started liking FMCG more and more. So, we are now overweight FMCG. We are not overweight banks, but we hold more banks than we used to. Especially PSU banks. I'm always a very nervous investor in banks. The people tell me, that's your takiya kalam that you say. That lending is a very risky business. So I'm always a nervous
investor. But you've chosen PSU banks over private banks.
Yes. We do have private banks also. As I said, we are not overweight. Also, remember banking as a sector, if you look at last 5 years prior to 2025, it underperformed in 4 out of the 5 years. 2020, 21, 23, 24. So other than 22, it did not outperform in any year. So sort of it is also a cyclical thing. And it is the highest weight in the benchmark, so I can't ignore it completely. Then what we've added very lately has been some of the OMCs, basically in the energy sector.
Right.
So I mean, we're not overweight, but that's the thing. And IT, we would be slightly overweight, nothing very spectacularly overweight. But what a system forces us to do is to look at things on both sides, unloved sectors. I'll give you an example like capital goods, industrial machinery. Our systems liked it in October 21 and we went overweight. Most other funds and investors discovered it 2.5 years later when the stocks had already gone up 2-3 times. And the reason nobody looked at it before that was for a good 12 years prior to that, it was absolute dog sector. From 2009 to 21, it compounded some 2%. So everybody said, we won't look at it. So that's why we use what we call a human plus machine system. So
I was going to ask you about that. Yeah.
So the artificial intelligence machine learning system, it kind of forces you to look at the data and not be married to the stories in your head.
So it's like a quant approach to investing.
Yeah, it is not a black box quant approach. That's why we say human plus machine, but it does the first filter. And my pinup, Daniel Kahneman, says that a system will always outperform a human being in any game of judgment. If you can, even if it is a relatively simplified system, the very fact that it acts without bias, it acts without noise, the randomness that human beings bring in, it will do a better job. Besides the fact that, of course, it can look at, many more companies, many more factors within a company and apply it on the same basis. I mean, globally, for example, we look at over 20,000 stocks. Even if I have 1,000 analysts, they're not going to look at everything in the same fashion. That's the part that only a system can do.
And I'm going to come to global in a moment.
Right.
But tell me about an instance where, let's say, your emotion was superseded by your machine.
So as I said that,
Like
maybe you would not have looked at industrial machinery, capital goods, because it had been such a dog sector. But in systems, this is something called a broken leg analogy, that the system will be better at predicting whether someone will go for a concert. So you should overrule only if you know for certain that person has broken their leg and won't go. So that's the whole point, that, I mean, we do apply a filter after that. Sometimes we will not go by what the system is saying simply because, not everything is captured by past data. But there has to be a good reason for that. So, for example, I'll give you in 2020, there was this whole thing of that you can't go wrong buying consumer brands which make a lot of cash. And I actually did a half-an-hour program on CNBC where I broke it down saying that these companies have underperformed for long periods in the past. But the point is that at the time that FMCG was the flavor of the season, nobody was looking at ITC because that was not performing. So for our systems, early 2021, suddenly ITC became very high up on the charts and we saw no reason to overrule it. So next 2-3 years, it was among our top 5 performers. So that's the sort of thing it forces you to do.
I remember interviewing Aswath Damodharan in peak COVID on a virtual conversation. And he was sitting in New York. And where I asked him after everything, I said, what's your favorite stock? And he said ITC.
Right.
And it was obviously in the boondocks at that time. And then it must have, maybe you invested jointly at the same time.
Yeah. So early 21, as I said. So that's what it forces you to do, because human beings are creatures of the story. We are very much married to the stories in our head. And without a system, you don't get over it. So that's the whole point.
Right. So you talked about this interesting factor about 10 days in the last 40 years, and that if you ignore those 10 days, 2/3 of your return go away. And you said if you make it 30 days, it's 90%. How does that operationally play out? I mean, so most people now, for example, have only a lot of investors have only come in the last 5 years.
Right.
If you look at the aggregate of investors.
Right.
So how would they even grasp something like this?
So that's the superpower in markets is not stock picking. It is realizing that equity returns are lumpy. So like there was this book on Rakesh Jhunjhunwala. The authors did not catch the kind of significance of this. But for me, that whole point of that book was one line where Rakesh says that I made a lot of money in 89 to 92, in 2003 to 2007, and there was, I think, 2009 to 11, and in between there were even 5 years when I didn't make money. I said, now this is the superpower, that that this is the nature of equity markets, that you will get 10 years returns in 3 years. And if you look at that whole period also from 94 to 2003, 9-year period, Sensex gave 0 return. It went up and then it came down. So it went up, I think, 5,000 plus. Then again, it came down, I think, 40%. And so 9 years, 0 returns. And then from 2003 to 2007, 6 times. So that is how.
Or last 14 months, no returns.
Or for that matter, you have this thing that, okay, Indian markets have compounded whatever, depending on the measure you take, 15-16% over the years. But let alone year to year, decade to decade, the variation is so vast. So if you look at the 1980s decade, the compounding was 12%. Next decade, 14, then 17, then 8.5, 8.8%. So that was the thing. So if you had put in 100 rupees in 1980, you would have 700 in 10 years. If it was 2010-11, in 10 years, you have only 230 rupees, which is about the same as the fixed deposit return. So because you had that whole decade of below normal returns, that's why you had that bull run post-COVID. So even now, we are not at the extreme end. So that's why I'm saying that I don't see big risk of a crash. As professional managers, what we do is that when we see any kind of question mark, then we would rather hedge. I mean, there are very few times we made a cash call. COVID was one of them, but then, and these are all both public calls on Twitter, that March 2, 2020, we said like something very strange and we went very risk averse, but within 3 weeks, we made the call that time to be back in. But that is, most of the other times we prefer to buy insurance. So basically puts. So that helps us many times, like the day Russia-Ukraine war broke out, the market fell 5%, we fell 1.6. At times you will buy the insurance and it will go unused, as happened at election time last year, that we were hedged, but the market was that went down for a very short period. So, but that also happens, but we always manage for risk first. So, I mean, when I say that don't get out of the market, doesn't mean that you don't manage risk. So we always have stop losses, for instance, and we have many risk management measures. I mean, and so So,
I mean, in a way, you're also saying that, I mean, if I were to just look at the data that you've shared so far, I mean, there's no way an individual, I mean, I don't know if there's no individual professional investor, but a normal investor cannot do all of this.
Yeah, so I mean, I have this thing that in my book also I have a chapter saying
Yes.
should you
This is
be
the book.
should you be a do-it-yourself investor?
Yeah.
I said look at your performance data, so your entire DP ins and outs and how that has done, and consider yourself as fund manager number A, and then you compare against all the other 5 funds or PMS or whatever you are looking at. And how they have performed, and how much will you give to this fund manager. And if you just want to learn, or the other thing is, it's been my long held belief that a lot of people invest in equities for entertainment, that otherwise what will we talk at parties, we can't just go and say that. So if you want to do that, keep 10-20% for that. And whatever you're doing yourself also, I said the best thing you can do for your portfolio is to say that whenever you make an investment, that I could be making a mistake, because no matter who you are, a large percentage of your investments are going to be mistakes. I mean, Warren Buffett sells out more than 50% of what he buys within 6 months, 85% within 2 years. So no one has this magic wand that they know the future in advance. Because life is a game of skill and luck. It's always a game of probability. Other than chess, there is no game of skill alone in this world. So,
right. So let me ask you about the IPO boom. And the reason I'm also asking, not because of IPOs and valuations, and that's a separate discussion, is because that's where a lot of investors enter.
Right.
And of course, either maybe benefit, but many of them do not. And again, as you look back, we are seeing a phenomenal IPO boom right now, and it looks like it's going to get into or head into December 2025, and maybe even spill over to 2026. But it's at a scale, at the kinds of companies, we are seeing companies which have never made profits, which is a new thing in itself, and investors are buying in. How do you see this as from the vantage point of someone who's been in the markets for so many decades? And you did touch upon this earlier as well.
Yeah. So I mean, very simply, if you are an investor and you want to behave sensibly, you should not be investing in IPOs when there is this kind of frenzy, when they are the flavor of the season, because most IPOs will be overpriced in that kind of atmosphere. I mean, that's the mandate the investment banker has to maximize the price they get for the company. And even if that is not the case, if it's a good company at a good price, then you won't get anything. So it just becomes a lottery game. And there was a similar frenzy exactly 4 years ago, October, November 21, which is when the first lot of many of these companies came in. And
many of them are underwater.
Underwater, or at least not match the index or anywhere close to that. Some of them, took 3 years. And if I go back to some of I remember one of the anchors said on one of these shows that, Devina, if I put a gun to your head, which one will you buy? And I said, gun to my head, none of these are worth buying. And he said, I mean, they might be overpriced just now, but another 3 to 5 years and the numbers will look different. I said, you have no visibility for 3 to 5 years, even for an existing company, let alone a new company. And you look at some of them. I mean, Nykaa was just as an example, was one of those which had profits at that time. So there's something to compare. I mean, all the peak numbers, the cash flows, margins, etc., were at that time. So the net profit margin was 2.5% then, it is 0.9% now. And the reason I had, even that time I had said, and this is something that it actually dawned on me from about 20 plus years ago, Hindustan Lever was planning to get into atta, and I'd spent time with Amul, even though it's not a listed company. And our own analysis was that it was not a good move. But anyway, we asked Amul, what do you think? Said, we don't think, this is going to be a good, profitable segment. But if Levers proves otherwise, we'll also start our own. So what is that? So that's what I had said about, companies which build a new segment, so to speak. So unless there is a moat, and most of these companies have no moat in terms of technology, they are either platform companies or direct to consumer companies. So the only moat is how much money are you willing to spend for either some incentive for the buyer or to build that brand. So and money is now available. So as I said, that if you build a thing, you'll attract others. And that's what happened. Like in Nykaa's segment, there's been Tatas have come in, Reliance has come in, everybody has come in, because if you prove that this market exists, others will also come in. As I said, I'm only giving it as an example, not that it's the worst of the lot or anything like that. But those are the things that are, when everything is priced to perfection, then you are not factoring for any of these things. And also this offer for sale is the other dangerous thing. I mean, in principle, there's nothing wrong with offer for sale, but offer for sale would make sense when the company doesn't need money. I mean, look at Swiggy. When they raised money a year ago, I think 4,000 odd crores were into the company, 6,000 odd crores was the offer for sale.
Exiting.
And now within a year, they want 10,000 crores more. So, these are danger signs. That they're saying, oh, we are in a competitive marketplace. Didn't you know that a year ago? I mean, so either way, it's not a good endorsement of the management that either you didn't know what you were doing then, or you're just raising money. So that, and also therefore the IPO investor might say that so and so big names have invested, but you are providing an exit for them. So and most of these IPOs were at 2, 3, 4, or lately even 8 times the last fundraise. So that's the price at which you are entering. And so this is, I mean, you are not actually, most retail investors are not even making any judgment that whether it's a business worth buying at this price. They think they are playing the lottery. SEBI data also shows that most individual investors get out within a week or two of the listing. So this ends badly. When it ends badly, you look for villains. But I would say that the so-called common investor who is in it for the greed is also to be blamed. If you read John Kenneth Galbraith's A Short History of Financial Euphoria, I said, like, in the end, you look for villains, but no one looks at the guy who was too greedy. So that's the thing.
But there are a lot of institutional investors, mutual funds, who also punt almost like individual investors, and have been and also benefiting with the pops that they've been seeing.
Actually, I mean, the thing is different, and SEBI data also doesn't show that the mutual funds flip out. It's the individuals who flip out. But then why do you have these big name anchor investors in what look like crazily priced IPOs? And I've been an investment banker, so I know this thing from the inside, that unlike the retail segment of an IPO, either the anchor investor or in a QIP, the allotment is discretionary on the investment banker. So if you look at some of these IPOs, while they're like list of big name mutual funds, they are putting in a pittance. They are putting in 0.0001% of their AUM. So why are they doing it? It is the investment banker telling them that I want your name to show to the retail investor. And why are you doing it? Because otherwise the stated or unstated fact is that when there is an issue where you want an allotment, the investment banker favors you or does not favor you. And I can tell you, I have done QIPs in the 90s and up to the 2000s.
Citibank? Huh?
No. Citibank was earlier. The QIPs was in First Global. So we did very, very selective ones where I was convinced that the investor would make money. But then what happened, especially during that tech boom, that you are doing an IPO as per the SEBI formula, and by the time that allotment happens 2 weeks later, the price has doubled. And then all your institutional investors are screaming at you, I was your friend, I'm your long-term client, how could you not have given me enough allotment? So that's how it plays out in a coveted IPO. And the investors, the viewers may not know this, that how much demand there is for an IPO is no indication of how it does thereafter. And the examples on both sides. I mean, DLF, let alone companies which have gone bust like Reliance Power. If you look at DLF, the company went on, but that IPO price was not seen for decades. Or on the other hand, Infosys was an undersubscribed IPO.
I've heard you being quoted on that before.
Yes, exactly. So, I mean, many people didn't know that. In fact, a journalist, I heard him say that maybe somebody's parent was lucky to get a allotment in the Infosys IPO. And I called him up and I said, do you know it was undersubscribed? The money was made by the underwriters.
So that's IPOs.
Right.
And let's talk about international, because you, I always have looked at an international portfolio rather than India. So if you look around the world now and what's been happening in terms of, let's say, the AI boom, or before that, let's say, the appreciation we've been seeing in companies like Netflix and so on, which you've spotted. Tell us about how you divide your time and attention between what opportunities here and overseas.
I mean, see, now a lot of the heavy lifting is done by the system. So we of course have been global since 1999. So we were not just the first Indian, we were the first Asian.
You were first and global, yeah.
Yes, I mean, so we were other than the other than the Japanese, nobody had gone west. So we became members of the London Stock Exchange in 99, and a year later of the NASD, which is the US Broker Dealer Association. So dangers are building up in the US, I think. That's the other thing. People think global means US, that ek NASDAQ or S&P kharid liya to ho gaya, but that is not how the world is. I gave the example of 2003 to 2007. Now, that was one time when the US was not coming off a high. It was already in the doldrums post the tech crash, and still it was a huge underperformer. That whole period, the emerging market index went up 3.5-4 times. India went up 6 times. Brazil went up 10 times. And the NASDAQ did not take out its 2000 high properly till 2015. So that's the history everyone forgets. People think that US always does well, A, and B, that the whole world follows what the US markets do. So there the market, of course, has become very narrow, which all of us know. And if you look at the various cuts, actually the stocks doing, besides this Magnificent Seven, the stocks doing really well are the ones with no revenue or no profits. So, and new technology, it sounds very sexy. Everybody wants to chase that. But in new technology, it is always that which technology will succeed, within that which player will succeed. And the third layer of that is, will they make return on capital? So if we go to the internet boom, it was that everybody in the world will use internet. So you can't go wrong investing in the infrastructure companies. So there were all these undersea cables laid down.
Fiber optic. But that people realized only later that, it was a good thing I invested in fiber optic cables and now they've done well. But at that time,
I'm saying those cables are still being used.
Correct.
But those companies went bankrupt 20 plus years ago, like Global Crossing.
Yeah.
So that's the thing. So right now, what you're investing a lot in AI, meaning many of these large companies have even hired people at $100 million salaries, hired a 2-person firm for 500 million, that kind of thing. Then you're investing in these data centers, which is a lot of real estate, lot of very fast depreciating equipment, and a lot of power. So are you going to make returns on that? That's the question. Because when the schools and colleges shut down, many of these AI systems, the usage dropped 60-70%. So that's not a paying population. So will you make return on capital on all this? And who will succeed? And whether, even looking at older technologies, if you look at the 20th century, which are the two technologies which changed how human beings lived? Aviation and automobiles. And both were a graveyard of companies. They haven't made money for investors. So even if a technology succeeds, doesn't mean it will necessarily make you a lot of money. So new technologies are very risky. There are there was this guy who used to write a technology column. When he retired after 40 years, he gave a list of all the technologies that were launched with so much fanfare. I mean, look at Facebook changed its name to Meta. That Metaverse is the new big thing. I mean, what's happened to that? Or Google Glass or 3D television. So, a whole lot of things.
So when we talk about AI in the way we are seeing it today, some of it will obviously work, and many of these companies are actually doing well. I mean, they already have running, good balance sheets, and maybe they're investing heavily.
Actually, the balance sheets have deteriorated.
Correct. Yeah.
I mean, there's a lot of debt also being raised in AI, both for these existing larger companies as well as these companies which have no revenue or profits.
Correct.
So that's another danger.
Correct. So that's, let's say, the Googles of the world or Meta and so on. But even in India, so when TCS announces that they want to set up a data center, the stock price fell. I mean, it didn't crash, but it definitely fell. What does that tell us?
See, Indian IT companies will be, my bet is that they have seen many pivots in their life from, Y2K. After Y2K, they were supposed to have no business left. Cloud came, digital came, so also AI came. So that they will adapt, because I don't see mega corporations handing over the keys, so to speak, to an AI. They will always need these intermediaries to make sure that AI does what it's supposed to do. So that they will do. I mean, my bugbear with them, which has been long standing, has been that they have done nothing to move up the value chain. Now, they always had huge amount of cash. They had access to trained human beings, but they have done nothing on with that. So that is a different thing. But on their IT services model, they might not employ as many people. So that's more of a danger for the Indian economy. So in the last 25 years, ITES has been the big employer. And then, of course, there's a whole ecosystem that comes around that, the security guard and the driver and the food delivery. So, but they were the primary driver of employment. So that's another question for but the companies themselves, I think, will be able to navigate.
So they don't need to get into data centers, is what you're saying?
No, I mean, that's okay. They might need to also. Okay. I'm not saying that.
That's a big shift. I mean, all of this so far has been IT services, manpower, people, and data centers is exactly what you're saying. These are large
I mean, let them try and see how it works out. But it's not something that they should not look at all. I have not of that view.
Okay. So as you look ahead, we are nearing the end of 2025. How are you sort of looking at 2026? What's the kind of portfolio construct that you would recommend or suggest? I mean, it could be the same as before, but are there any new thoughts?
So I mean, broadly the same. I mean, we've been underweight US this whole year. We became overweight Europe slowly from the beginning of the year. China, we had been overweight from last year itself, so that has continued. So we are just watching. As I said, I see the risks building up. So we obviously have investment in tech, though it is underweight relative to the benchmark. But definitely there are risks building up. As for, I mean, otherwise I have never in 30 years given a index projection because I think that's complete nonsense. And actually Bloomberg did data and analytics on that, because in the US that data is available going back many, many decades. And basically it's not worth the paper it's written on. I mean, every big name in the world, all the projections they give, the Citicorp and HSBC and Morgans and Merrills.
We've got quite a few that have come out in the last week.
So I mean, so this is the data that they are off on the average on the S&P projection by 15% points. So if they say +5, it can be -10, it can be +20, it can be anywhere. And the other point is that they all cluster between 0 to 10% every year. That's a safe place to be. But in 100 years, the S&P has moved between 0 and 10% only 14 times. So, it is complete nonsense. So, I mean...
and you'd say that the same applies to the Sensex and Nifty projections.
Absolutely. Okay. I mean, I saw someone saying that, I won't name the firm, but they have said that index target is 95,000 for Sensex next year. And their projection for this year was 93,000. So, nobody is holding you accountable for what you said last year and the year before. So this is something Daniel Kahneman calls objective ignorance, things which you not only don't know, but you cannot know. So I didn't know the term, but for 30 years, I have never on the new Samvat or January given any sort of estimate for where the indices will be. As I said, equity markets are not predictable in the short term. So that's why I say never have 100% in equity. Because equity should have money you will definitely not require for the next 8 to 10 years. So even if you are young, sometimes people say, I'm 25 in a good job, should I have 100% in equity? No, I mean, you might lose your job. There can be a medical emergency. You might need down payment for a home. So at least some portion has to be in more easily accessible and more predictable investments.
And how would you look at the India part? So, and the reason, let me sort of back up a little bit. This has been a very unusual year, right? We've seen since 2nd April 2025, we've seen a new world. Right. Trump has appended the global trade system, tariffs, penal tariffs, including on countries like India. Oil has been going up and down. Right now, of course, oil prices are down. India's own macroeconomic signals are quite strong, at least for the recent months. Now, is all of this adding up to something good as we go into the next year? Or how are you seeing it? Because we've not touched on macro at all.
So, I mean, as far as US is concerned, see, if you'd asked me last year, I would have still said that US has outperformed for a long time and at some point that will come to an end. But I did not think it was imminent. But Trump to some extent has, I think, hastened the end of that. And not just in market terms. I think he has hurt US on a longer term basis, because US had this image, some of it wrongfully so, of a place with great rule of law. I think they have the most awful judicial system, but they had this image that good rule of law, good institutions, freedom of speech. And that is the reason, I mean, US was not just a rich country, there are other rich countries, but none of them could attract talent the way the US could. And that is what you're hurting. And a lot of other countries are taking advantage of that. A lot of Western European countries are contacting researchers in various fields in the US and saying, blank check, come here with your team and your research lab or whatever. So that's another factor. As far as India is concerned, as I said, I don't see any big risk. Macro, see the macro stuff, which will also, as I said, I think the earnings will improve from the third quarter. And part of the reason is consumption has ticked up. Again, see, so much of the narrative is through the market view. So actually the trough in consumption was 23-24. But I think I was the only person in 24 talking about that the consumption is at a 21-year low. It's only when the market started falling in September that suddenly everybody discovered.
When you say consumption, you mean consumption growth?
Private consumption growth. So private consumption growth had fallen below 4%. The last time it was that low was 21 years before that. So now it has been accelerating. Inflation has come down. Food inflation has come down. So in certain cases, food prices have fallen. So more room in the household budget to buy everything else. Though, I mean, I have seen the other side now that rural consumption is slowing a bit. So that's the flip side to food prices coming down. And also for companies, some of these prices have come down. Crude has come down, which means petrochemical prices have come down. So there is a positive on the margin front also. Then GS. So I was expecting a improvement when the second quarter started. I thought that July to September you will see better results. But then in the middle came GST. So it was clear that some of it would get pushed because there was just confusion and disruption, and even though overall it's a positive thing, but that meant that the earning improvement, I think, it got a little push to Q3. So you will see better earnings. As I said, the P's are not that high to start with. So those are the positives. Of course, things are not quite as good also as some of the numbers, because if you see, if everything was that great, the RBI should have cut rates further because you have as benign an environment as you can. And I think two unstated things is, one is that the cut in interest rates, the markets have not really brought down rates to this extent. In fact, some of the state bond issues are not getting subscribed. And also the other thing is, which you're not talking about, is the currency. Because now the interest rate differential between India and US and other Western countries is the lowest. It is in the 2% range. Norm is around 5%. Peak is around 7.5 or so. So as for that, if interest rates are low, you will attract less money, and therefore the currency, there is pressure. So that's the other part. I was just looking at data yesterday that the NRI deposits are falling because again the interest rate differential is now no longer as attractive. So those are the unstated kind of pressures. So I mean, whether you should at all try to keep the rupee up is another question altogether. That's a whole different debate.
I mean, there are some who are arguing for gradual depreciation or letting it go where it is or where it will go, and others maybe.
And in fact, that is the reason, one of the reasons why Indians should invest globally, and they don't. I mean, I always give this number that when I started working, the dollar was 12 rupees. So in the less than a career, you have a 90% depreciation. So when you are talking of long-term planning, long-term financial goals, 10, 20, 30 years hence, how can you forget this? And now, if anything, the foreign exchange expenses have been rising. More kids study abroad, people travel abroad more and more. So you should definitely diversify out of India. But that is not like a one-year knee-jerk thing. So, I mean, right now, because India hasn't done well, people say, oh, global le lete. In 2022, I had the reverse thing. People said, why did you tell us to buy global when this year, India has done so well? So it is a long-term asset allocation that you have to think about.
Yeah. Last question, and in a way to maybe sum up what you've talked about in the last 40 minutes or so, is how do you then set your benchmark for long-term investment? or investing?
So,
is it a time benchmark or is it a personal return benchmark?
I think first of all, I mean, investing is neither as simple nor as complex as people make it out to be. So don't try to optimize. You are okay if you get 85% of the way there. So don't look for the multi-baggers. Get your broad asset allocation right. Put the risk management parameters, especially stop loss, in place. Do proper global diversification. That's all you need to do. That's so. First of all, look at where you are invested currently. I mean, that's the first part. I mean, most people don't even know what their current investment looks like. How much is in real estate, how much is in gold, how much is in fixed income, how much is in equity. So you do that and then do a conscious decision on that. And as I said, don't have 100% in equity. Gold is another thing people keep talking about. Yes, have something in gold and silver, but not a huge amount. I mean, our grandparents, our grandmothers were very right in investing in gold because then you could not invest globally. So that was the only hard currency asset you had access to. But now that's not the case. So,
Right. Yeah. I mean, and I didn't ask you about gold, but I know that you're sanguine about gold. Would that be a correct way to put it?
Not. I mean, it's quite run up too much, and I mean, we have a gold in our global multi-asset, or even for that matter, India multi-asset, but single-digit allocation. It is not like 25% or something like that.
Right. Okay. Right. Devina, we've run out of time. Thank you so much for joining me here.
Thank you for having me.
Thank you.